Welcome to another week of the Educated Home Buyer Live. Myself and Josh are here to answer your mortgage and real estate questions while updating you on the economy. Josh, you don't look engaged this evening. What's going on?
Well, Jeb, I was looking at my Arcos data here because I hit a really good drive on 9 last Friday, and
Get out of
I
here,
wanted
bro.
to see the measurements, and it wasn't as good as
Get
I
out
thought.
of
It
here.
wasn't as good as I thought.
All right, guys. Thank you for joining us another week. Big news this week, which we're going to talk about, is inflation coming in higher than expectations and mildly sending rates a little bit higher today. So, the title of the episode is Mortgage Rates Have Peaked for 2025. The question is, does that data change that? We're going to be talking about it as we dive into tonight. But while we're discussing that, do us a favor. Put your questions in the chat. Let us know where you're watching from, and anything
And
else that you want to talk
let
about.
us know if where you're watching from, it's raining in 58 degrees, like this horrific weather we're suffering through here in Southern
Dude,
California.
I was watching Instagram this morning, and there's a couple of people that I'm friends with that literally shovel, like their driveway is like 30 yards long, and every single day they're manually shoveling. And I think, why do these people still live there? Why would you
It's a
do
good
that
point.
to yourself
It's a good
every
point.
single day? But anyway, that's where we're at. We're going to go over some charts as we always do. And as we're doing that, again, start putting your comments in the chat so that we can get to them as we come out of this quick conversation. So, Josh, let's do this. Let's start with available inventory for sale. So, this week, actually, inventory ticked down once again, sitting at 632,000 homes. Not unusual for inventory to bounce down in February, but it is a little reversal from what we saw in January. Typically, we're starting to see inventory rise here the next couple of weeks. And what we saw is it come in early in January, started to rise, and now it's ticked back a little bit. But you're going to see from the numbers here in just a moment, it's not that much lower. But we are sitting nearly 28% more homes available now than the same time last year, 27.8%. With that, as I mentioned, we are from 634,979 homes to 632,367 homes. Not that big of a move down, pretty much status quo across the board. But our peak last year was 739. We're a ways from that, but we are likely to see inventory start to increase here in coming weeks. So active inventory for Orange County sitting at 2,955 homes. That's up 2.27% week over week. Huntington Beach at 213. That's up 3.76%. So the last time we saw this many homes on the market in Huntington Beach was back in November-ish, November 20-ish, somewhere in that ballpark. And for Orange County back in early December. So yeah, again, nothing crazy, as you can see from the charts, but we are starting to see that inventory come to the market. Supply. So what's happening with new listings? So unsold new listings were 3% more this week than last year. Immediate sales were 30% fewer. In total, 64,000 new listings versus 66,000 a year ago. And that's going to take us into active inventory. So this chart is comparing January of 2019 to January of 2025. The dark green areas are the areas where you've seen, an increase from that time period. And then anything that is, I guess, not greenish, heading towards the more browns is down from 2019. So look at it. Texas, Florida, kind of the middle of the United States is kind of going all the way up to Montana there. Montana? No, that's not Montana. That's North Dakota. Right? Yeah, North Dakota is where you're seeing the increases, but primarily down in Texas. Texas seems to be the big one there, Josh.
I saw Diana Rossini on CNBC today talking about inventory growing exponentially. She seems to be misunderstanding the
Is
term.
that Diana Olick? Did she change her name?
Oh, Diana Rossini's on sports ESPN. So yes, I got myself confused.
Oh,
So
I thought maybe she got married and changed her name. I'm
oh
like, you
no,
can't
that
do that.
woman's never
I
getting
know
married.
that
I
name. You
assure you,
can't
it was
change your
Diana
name now.
Olick. No,
Yeah.
I got my Dianas mixed up. But yeah,
Okay,
she
I
was.
confused there.
Yeah, she
Fair
was her normal pessimistic self this morning, telling us all about how terrible everything is with the housing market.
Well, this kind of goes with what she's saying here, Josh. So this chart can be hard to read depending on what you're watching us on, but this just shows months of supply. Miami over 7 months of supply. And again, a lot of these states are going to look very similar on that map where you saw the really dark green areas, but you can see the majority of the ones that were up here aren't anywhere close to where Miami is, or even close to that 6% that we've traditionally used as what we call the seller's market. So more balanced out there in most areas. As you can see, the closer you get down to the bottom of that list, it's going to be a strong seller's market. The higher up on that list is more of a buyer's market. So most of the middle, I would say 2/3 of that chart's probably more of a balanced market than anything else. Josh, home prices up 2.4% more than 2024 when we're talking about newly pending sales. Coming in right now at 389,000. Let's see, and let's take a look at.
Remember, we haven't pointed out the obvious that we like to share so often, Jeb. That's a median price of contracts pending. Median prices of any version suck.
Yeah, absolutely. We always talk about the median's not really the number you want to follow, but that's how the data comes out. So this just shows contracts pending, home sales averaging about 5% below last year. So 57,000 new sales currently under contract. Again, it's rates, it's affordability, it's all the things that we talk about. But we have to continue watching just to see what that looks like. And then that takes us into price cuts, sitting just over 33%. And now for this time of year, we're the highest that we've been going back sometime. So we've got more price cuts on the market, which again is somewhat expected just because of everything going on. And then this chart, Josh, is something that we talk about. We don't really talk about it that often, but you can see where mortgage spreads are now versus where they've been in the previous years, and even where they were back in 2023 at the peak there, over 3%. So one reason that we're not seeing that 8% handle on rates, or even the high sevens for that matter, is because even though the 10-year is higher than it's been, over the last couple of years, well, these years excluded, if you will, we're sitting 4.6 today, Josh, with a 2.3 something spread, somewhere in that ballpark, which is giving us rates, just around 7%. Whereas at one point we were over 3%. So if that were the case today, you would have interest rates in the high sevens, almost 7.75. So those spreads improving have allowed interest rates to come down.
And the big thing with that, the cure to high spreads is lower rates. The servicers are concerned that there's no value in the servicing when rates are high, because as we saw last August and September, as soon as rates dip, everyone refinances out of them. So someone doesn't want to pay up for the rights to earn a stream of income in the servicing over 5, 6, 7 years if they think there's only going to be a 2-year stream. So they've kind of adjusted without rates coming down a ton. But if we get rates consistently in the 6.25, 6, 5.75 range, you should see that spread normalize even more down under the 2% range.
All right. And then this is just basically showing the 10-year, which, again, this chart is no longer accurate, Josh, because of what happened today. So we're going to move past that. I thought this chart was interesting. We talked about this before, just showing where the average age of the first-time home buyer is today, sitting at 38, whereas back in the early 90s, it was 28. So it's up a third since mid-90s, actually more than that, just because of affordability, because of all the things that we talk about.
I would say, look at this. I would throw that 28 out. I would love to see what it was in 87, 82, somewhere along that line. That 32
chart doesn't go there, bro.
That 32 line is pretty straightforward. We had a period where it dipped, and that's different. It's different from a generation ago. Our parents, I say like we're all the same age. Old people like me, our parents who are now 75, 80 years old, those people were getting married when they were 20, 21, 22, 23. So by the time they were 26, 27, 28, it's like, dude, we got to buy a house. People are doing everything later, graduated from college if they go to college later, getting married, starting a family, buying a home. So that is all kind of the new normal. What's not the new normal is this 36, 35, 38. That's affordability. It's requiring that, more established person to be able to buy a home now.
And this just takes us into the median age of all U.S. buyers, right? So, of all sitting somewhere around 56, whereas you have repeat buyers right now, the average age is, or the median age is somewhere around 61, right? So it's a more probably a buyer with more money, with more stability in jobs and life and finances and everything. And those are the people in this market that can buy homes versus again, going back to the left side of this chart, much younger age at that point. So
I have a theory on the yellow ones, aging older. Um, Older people like me, once upon a time, 50 was like, hey, you're done. You're going to retire in 12 years and you're going to die 5 years after that. Now we got people 70, 75, 80 still doing stuff, including buying new homes, buying a second home. So just as people do things later and older people are younger in terms of their behavior, I think there's more of them transacting than what we had 20, 30 years ago.
I agree with that. This is Josh. Let's a lot about insurance going on at the moment. Things happening, for multiple reasons, but this just shows the share of homeowners without home insurance. So, what are we looking at?
Well, remember that if you have a mortgage, your lender is going to require you to get insurance. As part of your loan docs, you are signing to say, I will agree to maintain acceptable insurance on my property. And if not, you can put it on there for me to secure your interest in my home. So we talk about, what's the number, Jeb? 40% of homes free and clear?
Yeah, I think it's right around 40 at the moment.
So if you're down there in Florida and you're on the Gulf Coast and a hurricane just came through and somehow your house was spared and the insurer comes through and goes, I don't care how or why you were lucky, but I want $10,000 a year now for insurance. Some of these people are just saying, pound sand, I'm not going to have insurance on that property anymore.
I've told you this before. I've got a buddy that lives in Coral Springs, Florida. He's done very well for himself. He doesn't a multi-million-dollar house. He doesn't have insurance on it. His whole thing is there's no way a hurricane's going to take my entire house, but it could damage it. And based on what I would spend for insurance, I would just pay that out of pocket to go through that myself. And I'm not going to pay this. So there's people out there that can do it for sure.
I thought it was an interesting chart. You can see the parts of the country, Texas, Florida, kind of what you would expect. I don't know what's going on in West Virginia, California. We got wildfires. Some of these people that own their homes free and clear are going to live fast and loose because a fire will destroy 100% of your house. This, Jeb, I thought was interesting. Just a breakdown here of where people's budgets go in terms of annual expenditures. Housing is obviously the biggest one. What I didn't have time to do this afternoon, I wanted to dig out because we've talked about it a few times here in the intro to the show. Homeowners have a much lower housing cost than renters do. And people go, you're crazy. Owning a home is much more expensive than renting. It is, but we've got 40% of those people that have no payment. Of the 60% that do, they bought at lower prices. They refinanced to lower interest rates. So two thoughts came to me when in looking at this. That big chunk that you're having to put towards housing when you're renting is hard. It's a hard barrier to cross to be able to get into a home. And then the second piece of it is once you do fix it, for the first 7, 8, 10 years, time's moving slowly. You don't really notice much of a difference. But at some point you'll look up in 12, 15 years and go, whew, I have a much lower housing cost than if I were renting. Just threw this one in here, Jeb, as a reminder. We get with a new presidency every 4 years, we get to hear that they're the cause of changes, things going on. February is the worst month in a post-election year. January is always a relatively good month. You get window dressing with tax allocations, things of that happening, people trying to get their year-end bonuses, whatnot. But February does not benefit from that. So regardless of who's the president, we generally see this as being a pretty bad month. So what I thought, and Jeb, what are your thoughts on this? We would normally, and I meant to go back and try and pull the data for bonds. Stocks and bonds compete. When money comes out of stocks, when stocks perform poorly, you generally see bonds do well. We've seen the stocks doing poorly so far in February. We have not seen the bonds doing well. This one here, household net worth is close to 8 times disposable income due to strong financial and real estate asset gains is a tailwind for confidence and consumption. So wanted to throw this in here. You and I had a conversation earlier today and a recording for the podcast of that rent versus own dynamic and why owners end up doing better over the long haul. But I also thought when I was looking at this chart, I said, this explains a lot of the resilience in the economy where people are going, oh, everyone's struggling. People running up credit card debt. No one can afford. Home prices are so high. And for many people, that is true. But for many people who have assets, who've seen their stocks go up 50% in the last 2 years, who in the last 5 years have seen their home value go up 50% and refinance to a lower rate, those people are in really good position and are able to continue spending regardless of what's going on in the current economy. So here we go, Jeb. Here is the CPI data that we got today. I like to zoom out. If any of you watched the report, watched the headlines, Caesar, who was listening last week and asked the question about non-owner rates, we just opened his loan this morning and he called this morning and says, hey, I saw that was a terrible report. Did we get me locked in? So he was locked in, but everyone following this is seeing that we had a bad inflation report. But if you look at the scale of this, the last 3 months are a bad trend. There's no two ways about that. But you're going to see that the market didn't take this nearly as bad as you might expect, getting a 0.5 read month over month. So this is core. We strip out the core. It was a 0.4. But you can kind of see we have plateaued. We're not seeing the improvement that we want. Somewhere in that 3% range is where we're at. So year over year, I'm just pointing out here the headline CPI, we had a nice run down off of those horrible high numbers from 2022. And then the waves seem to be ebbing lower, but still not where the Fed wants to see it with PCE, not the CPI data here in the 2% range. This is the core. The core made that nice run down and has really been trending sideways for the better part of a year now. And that's not what we need to see for interest rates to get better. Wanted to throw, we always show you the big chart of the daily chart of the 10-year over a long time frame. This is the hourly, just over the last couple days. That giant green candle. If you own a stock, you like seeing the green candles. With bonds, you don't like seeing that. That was pretty much the hour this morning when the news hit. On CPI, the market didn't like it. Shot up, from 454 to about 464. So about 10 basis points, which is about 1/8% in mortgage rates for you in about an hour. Trended higher for a couple of hours. And then by the time we got to the end of the afternoon, saw some improvement. So that's good. That's a positive that the market didn't freak out and just end on the worst levels of the day. These again, Jeb, are Heikin-Ashi candles. They're a little different than the candles that you're looking at, but we're still under the bottom side of that range, but shot way up into it at the worst levels of the day. The next couple of days are gonna be important. We get PPI tomorrow. If we show a little cooling there relative to what we saw today, we might get some back. If you get a hot PPI report, the market could go bonkers. One never knows. Big picture, I just wanted to point out when you're seeing a lot of negativity in the news, in the headlines, we're an 8th higher week over week, 0.14 on conventional loans, 0.15 on FHA and VA. So really not much changed over the last week. We were hoping to come back, and we hope every week we're going to come back and give you good and positive news. Didn't get that, but it's not nearly as bad as you may be seeing. Oh, I skipped ahead, Jeff.
No, it's all good. You can put those names up there. So, when we did the education, the first time home buyer webinar a couple weeks ago, we asked for feedback. We had 230 people or something. I forget the exact number on the webinar. And one of the things that we did after the webinars, we sent out a Google form, basically asking for feedback, like ask just a couple basic questions, what you thought, blah, blah, blah. And we had 10 people, 10 out of 200 and something. So not
it's a low number when we're offering a $100 potential bribe.
There you go.
These folks have a 1 in 10 chance,
like less than 5% return on that. But these people actually answered it, and for those, we're appreciative. So we did say that we would give a $100 gift card to those that filled it out. We would draw a name. So what we're going to do here is, we're going to use technology, Josh, and we're going to use. I'm going to share my screen here for a minute if I can. If I'm going to try. Can you see my? Let's see here. Let's see. Can you see that screen right there, Josh?
There we go.
Is it formatted correctly, or does it need to be smaller? I can't see.
I think we need to. Does
that work?
It's going to work. It's going to work.
So we're using GPT. So I'm just asking it to pick a number between 1 and 10. Whoever it comes back with, whatever number is the person that's going to get the gift card. So I'm going to hit this, and it's going to tell us, Josh, that it is number 7, lucky number 7 it picked. So how does that translate into our thing there, Josh? Can you pull that back up?
There, I wanted to show you that so that everyone could see that it is, in fact, number 7.
There you go.
But let's go back here. So Kim S, which
Kim S.
Jeb, that is Red Apple's Kim. So hopefully Kim is here and she finds out that she won. If not, we will email her. We will let her know. So Kim not only came and participated in the webinar, Kim is going through the pre-approval process, which Kim's been here for a number of years. We're gonna get this figured out. We're gonna get her into a home. And she completed the post webinar survey and
Awesome.
has just won $100.
Cool. Very good. So for that, we appreciate you. If you're still out there, have a higher rate than you want, and hoping to, have us reach out or know when rates go lower, you can go to jebsmith.net/rate watch. As rates trend lower, we'll reach out and update you so that you can stay updated without having to follow it like Josh and I do, and beat your heads against the wall every single day.
Groundhog Day.
Groundhog Day. It is Groundhog Day, Josh. Okay, so how do we get back to where we were? Like that. Okay, so Josh, I'm going to ask you a question. I got an email this week. So before we dive into the questions here, I got an email from a viewer, and they asked me a question that I'm going to get your answer first, and then I'll give my answer. They're considering selling their home. They're here in Orange County, considering selling a home. But the caveat is they want to lease back. So they want to sell it now with the idea that they're going to find a buyer that's going to allow them to lease it back for hopefully a year. What are your thoughts on someone selling the home with that intent? Pros, cons?
So they're selling the home and they're going to lease it back?
They're going to lease it back. They want to stay there. They want to sell it, take the capital now. Possible divorce situation. They want to pay the other person off, right? Have the funds, pay the other person off. But the person that's remaining in the property is going to need some time to get
one
out.
of them is going to lease back. One's hitting the road, and one's leasing back.
Yeah. One's going to lease back, but it essentially needs more time to be out of the property, whoever that person is.
If you can get a good amount, a reasonable lease, at a rent that is fair to everyone, I don't see the downside to it. I was funny as you were asking the question. I was thinking that they were the ones doing the lease back, and they were like, "What do you think about this?" There's some risk to the person that's buying in terms of leasing it back, but there's risk anytime you're leasing a property. So as a buyer, I don't see any downside. You're giving yourself 12 months in a place that you're familiar and comfortable with before you have to move on. So from my end, I don't see any downside to it. How about yourself?
Okay, so maybe I didn't explain the question because I don't feel like your answer. So they're looking. So they own the house now. They want to sell it. They want to stay in the property. My response to them was this: that can it be done? Yes, it can be done. Are there downsides to it? Yes. The downsides in the case that most buyers out there are looking for owner occupancy, right? So they are, if whether they're selling something, they're renting something, they're doing something, when they're buying a property, chances are they're looking to move into it. It's rare to find a buyer that is willing to say, you know what, I'm going to buy this now. You're okay staying in it until a year from now, right? Because again, if it's an owner occupied loan, there's problems with that, so on and so forth. Can you do it? Absolutely. The downside is, example, if you have 100 potential buyers, you're going to lose a good majority of those buyers that might be
95 of those 100.
Sure, because of the situation. The other thing is maybe some it's outdated. It's there's other things going on in the property. So it sounds like it's an investor type of purchase. Somebody that's willing to buy it. Hey, they know the intent. We're willing to sit on this for some period of time. I told in the email response is that I think the downside on top of that is there's probably some sort of give and take on the price a little bit, right? So if your home is worth at X, let's just say 500,000 for our conversation here, you might have to be willing to come off that number just to find an investor or somebody that's willing to work with you. And for that time, right? That time is not free money. Even though you're going to be paying a lease, it is somebody's money is tied up in that property, and chances are the lease that you're going to pay is probably not going to cover that whole amount. So I just wanted a different opinion, but
in simple terms, supply and demand, right? So there's a certain amount of demand for your home, and you just eliminated at least 90% of it. So it goes to follow that you're going to limit. I thought you were saying that they had someone that was willing to do this. If
No,
you
no,
have
no.
someone that's willing to do it and you're comfortable with the price they're selling, this could be a wonderful solution for
Sure.
you. And you hinted at, but just to be super explicit, anyone who said, "Hey, I am going to own or occupy, but I would be cool with this. I'm getting a deal, or I'm not ready to occupy." When I bought my first place, my wife and I were engaged. We didn't need to move in, so I left the tenants in there for a year and a half. So there are buyers out there that are cool with that. But if I'm getting a loan and I'm saying I'm going to own or occupy, my occupancy affidavit says I am moving into that home within 60 days. If there's a lease in place that doesn't allow me to move in within 60 days, that the lender is aware of when they're underwriting, they're going to go, "No, brother, that is a non-owner loan and you're going to get worse terms."
There you go. Good stuff. So I don't think there's anything to add to it. Just wanted a different take on it just to make sure we're clear. But hopefully, viewer, if you're watching, you get the answer that you need from that to be able to make the best decision possible. So that said, Josh, we got super chat from Miss Mina. Mina also has a question. So thank you for the $5 there. Mina, appreciate you. Just says, in my new construction townhome, for about 5 months. Developer now building multi-million-dollar homes a block away. Should I be concerned about taxes going up? So, Josh, if you're in one of those areas where your taxes are assessed every couple of years based off what's happening in the market, is this something that could impact her and make her taxes go up?
I'm going to use an example, and it's a bad example because it's in California. California, we have Prop 13, so there's limits. But let's just assume this has happened somewhere else. I have several clients that bought in Inglewood and Hawthorne right before or while they were building SoFi Stadium. And all that development, I'm not saying just the stadium, there's a bunch of development. They put Intuit Dome, restaurants, lots of redevelopment around there, and it's made the area more desirable. Home prices have gone way up. So if we didn't have Prop 13 in California, you could be reassessed. Those people would be looking at higher tax bills. But at the same time, they're also benefiting from vastly higher prices. The first person that told me, like, they didn't even have the permitting for SoFi. It was like 2017. Guy tells me, hey, that he bought a duplex in Hawthorne. And he's like, this is going to be big. This area is going to be crazy. I'm like, what's a nice area? People like it. But I think you're getting a little carried away with a stadium. Well, he bought a duplex for $410,000. That stuff went up extraordinarily. So when I hear that, say, is there the possibility that you could have some negative tax consequences? Yeah, but if you do, you are going to benefit from increased appreciation. They're not going to look at those higher priced homes and go, "Oh, these lower priced homes get taxed higher." They're going to say, "Oh, these are really similar. If these are going for $1 million, that thing's worth 800,000 or 900,000."
Yeah. If it's not a similar property to yours, for example, if you have a townhome and that's a single family home that they're building, it's not going to be dollar for dollar, right? It's a different style of property, and that assessment shouldn't be exactly the same across the board. But could it cause them to go up? It could. But Josh said, that could benefit you with higher prices in the future if you go to sell. Hopefully that was helpful. Josh, so Carson mentioned that they got quoted a 7% rate, and they needed to come here as soon as possible. So 7% today, pretty reasonable rate across the board, wouldn't you think?
Well, we have a listener to the show. He's listening tonight. Just got an offer accepted. Why am I drawing a blank? Somewhere in the Bay Area. And with that, they were well below that. I mean, he was putting 20% down, 800 credit scores, but well below that. So it just depends. What are we doing? What type of loan? Where are the credit scores? Could be good, could be bad. One never knows. But instead of getting quotes from someone else, why don't you call us and get a quote from us?
There you go. jebsmith.net/start. So that you can start the process and see where you stand. So jebsmith.net/start. We'll put it on the bottom of the screen. And there you go. You can talk to Josh directly and see how that works out. So Josh, similar question here. Not exactly, but Jake says have a new home under contract closing in April, May. They have the option of a 90-day lock at 6.875%. Is it worth it? Should they wait?
I don't like the current market. I wouldn't tell you rates aren't going to be lower in 90 days. I wouldn't tell you they're not going to be higher. Topic of the show tonight, mortgage rates have peaked for 2025. We seem to have hit a ceiling somewhere in that very low 7.125, which were the Mortgage News Daily number that we showed at the top of the show is just over 7%. I think we're somewhere near the peak. Does that mean that I think that, hey, we start descending rapidly now? I don't. When I read this, I saw the word option, and I was thinking that you have an option to float down. A lot of the builders do that because they want to get you locked so that you have some certainty and you're less squirrely through the process because of less stress. I would ask what the float down option is if rates are lower, because I'm not saying they will be, but they could be. They could be a 0.5% lower in 90 days. We don't know. So the big picture, Jeb, what does it come back to? It risk tolerance and what your comfort level is. I'm not worried they're going to go a lot higher. I'm not hopeful they're going to go a ton lower, but as they say,
You aren't hopeful they're going to go a ton lower?
Stuff happens.
I'm hopeful they're going to go a ton lower
in 90 days.
I'm hopeful of that.
Okay.
I'm not thinking they're going to do that, but I'm hopeful. Anyway,
Jeb's trying to pass himself off as an optimist, and
dude,
to anyone that knows
optimistic.
Mr. Smith
I'm
that not to be the case.
I'm not a pessimist. I tell you like it is, and people don't like that, and so that doesn't really go over all the people like, oh, I don't like that. Well, fuck, I don't know what to tell you. Like, do something about it. Change your situation. Change your philosophy, Josh. Change your life.
Change your philosophy. Change your life.
There you go. No, in all reality, just joking around. So we do have a couple people answered the question earlier about where they are. So I feel like I need to go back and mention those just because I asked the question. So we got Alex in Central Florida. We have R. Baker in New Jersey, but planning on buying new construction in Delaware. So they're going to relocate. John's in Georgia, Mina's in Maryland, Patrick's in Georgia. We got the East Coast covered here. Patrick's in Georgia.
Why is John watching from rainy Georgia and Patrick's just in old Georgia? Is it not raining in all of Georgia tonight?
That is possible, Josh.
I'm just happy to hear that it's a rainy night in Georgia. I can hear Brooke Benton singing in the back of my head. All you young people are going, what is this guy talking about?
Goodness. Let's see here. Jake came back and said 0.375% of the loan amount to float down near closing, but only granted this option once. So, I mean, depending on your price, that's not a cheap option, but
so what does it do? When would you do that? If the rates drop 0.5%, I can get 0.5% lower for a 3/8 cost. I'm going to do it. If the rate is 1/8 lower for a 3/8 cost, I'm probably going to think pretty heavily about it.
Very good. Good stuff. All right. So Josh, that's all the questions. It was fun tonight, guys. Now, if you have questions, put them in there. We actually have one here. Mr. Chang is what we're going to say.
That's a podcast episode. That's not a question.
What are the top 5 must-dos in your home after closing? Josh, what's your number one? I got a number. I got a 1. I got a 1 that's the first thing you have to do in owning your home.
If there's any carpet, the carpet has to be changed.
Paint and carpet. Not where I was going with
paint and carpet.
That works.
Toilet seats? You going toilet seats?
No, I'm going a completely different direction. You got to put it into a trust, or you got to have a will. Oh. You got to have something that says where the property goes. My neighbor, my old neighbor, from 12 years living at the house that I was at previously, still my neighbor, just not quite as close, stops me the other day and says, "Hey, do you have a good trust attorney?" I said, "Yeah."
I do it myself.
I have a handful of people I can refer you to. He's like, I got to get this situated. I go, your property's not in a trust. Granted, he and his wife both retired from Boeing years ago, early in Boeing. Financially, I think they're very, very well off. They travel a lot. They've got, house paid off, the whole thing. I was shocked. He's probably 80 years old or more.
So this is inevitable.
To find out he didn't have a trust or some sort of directive to say what happens, I was like mind blown, because I thought if anybody did, he's an engineer. His wife's these people have it together. No, but guys, if you have anything in your property at all, any equity, you want to leave that to somebody. You don't want people to fight over it. You don't want it to go to court. You don't want additional costs. Spend a little bit of money and say where that stuff goes. You only have to do it once, unless things change, and then you have to update it. But it's smart. It's the right thing to do for everybody's part.
And anyway. Jeb, even beyond that, I think I know a lot about this stuff, but in going through that process, we're not done. So I'm one of those people also doesn't have mine in the trust. Just learned a lot about how vesting should be handled and held. So a trust attorney, Jeb did do it himself. Jeb had gone through it with a trust attorney, then redid the new one himself. it's one of those things where you absolutely can, but there is some great value in just having that conversation and going back and forth with a trust attorney on where we're at.
And the same thing goes for like, this is off topic, but like medical directives, like that sort of thing. Like what happens to you if you're in this situation or that. And nobody wants to talk about that, but the reality is something could happen and you need to cover your bases. So off topic, but that's where I would go. But Josh, if we're talking directly about the house, then that's a little bit different situation. But maybe that is a podcast episode that we cover.
I don't like touching surfaces other people have touched. So I'm going to go through paint, carpet, toilet seats, all this stuff. I just don't like it.
All right. Bleed green. I have a
mid-score.
A mid score of 625. Should I go new construction, wait 7 months and hope FICO goes down, or buy now?
Is not a strategy.
Correct.
So I'll tell you this, a 625 can be a 680 in 90 days, but not by hoping it's so. You can do it yourself. We've talked about this on the show. I have a very good credit repair company that we work with, very reasonably priced. A situation like that, you're probably going to spend $300 to $500 to work with them for 90 to 120 days. But the difference between 620 and 680 is like light years. People are possibly going to disagree with this or not like this, but I don't think if you have a sub 640 credit score, you should be buying a house. And that's not to say that you don't deserve a house or that shouldn't be a goal. I'm saying step number one in that process should be getting that 625 over a 640 so you can get really good terms with an FHA, over 680 so that conventional can become an option, or if you're home ready, home possible eligible. Those are the things we're looking at and considering. But we talk about readiness, buy when it's the right time in your life. People have things happen. Good people that are on top of it, that manage their finances, things happen. So I'm not saying that you are not worthy of a home with a 640 credit score. I'm saying you are capable of getting a much higher score and putting yourself in a better position in a relatively short period of time. And that for me would be job number one.
I don't disagree with anything you said. I think it's not that difficult to get that 625 credit score up to a 680, 650, whatever. At least 20 to 30 points higher pretty quickly to get a much better interest rate. And that's what I would focus on versus trying to do things after the fact and then hoping all of those things changed, right? Because there's costs involved in all of that stuff. And I wouldn't go pay somebody a bunch of money to go do this either. Just being completely clear. There are companies out there that are reputable that can guide you, but people that are charging you $2,000, $3,000, $4,000 to do this stuff, it's a ripoff. Don't do it.
And if they're just telling you, hey, we're going to dispute all this, disputes, no matter who you work with, is going to be a part of the process. But that's like, that is a hope portion of it. They're going to tell you, hey, we're going to send off a bunch of letters and hope that they just don't want to deal with this. And so we get a couple deleted easy. We get the easy button on that. Most of these, they're going to respond. They're going to show that you owe it. They're going to show that you missed the payment, and they're going to want to get paid. And we're going to have to do some work here. But just while we're on the topic, Jeb, we probably should just do an episode on this. What I see. So the company that I refer, if you sign up with them and you authorize them, they're going to keep me updated. So once a month, I'll get updates and I go, oh, that is so awesome. Bleed green here is up to a 642 now. And maybe 3 weeks later, a month later, 2 months later, it comes back, oh, it's a 675 now. We're getting there. I see people like, you should not be in credit repair for a year. If you're going to get it done, you're going to do the things, you should be able to get it done in 3-6 months, somewhere in that range. I see people that pay this bill month after month, $100, $150, whatever it is, for like 18 months. And the little chart says beginning balance, target balance, current balance. And they're moving further away from the goal while paying someone to work on improving their credit. Don't be that person. Know who you are on the way in. Either you are ready to do the work, and that is step number one to buying a home, or don't waste the money.
Good stuff. I want to address this question because I think Mina, obviously a big supporter of the show, but I think there might be a misinterpretation of what a home warranty does. So is it better to make a list of action items?
Hold on, Jeb. I just want to make sure you're thinking the same thing, the same track. She didn't buy an existing home and get a home warranty. Hers was new construction, and you have that builder warranty for a year. So I think she's more thinking in terms of any construction defects, anything that I don't want. So Mina, correct me if I'm wrong, but I want to make sure Jeb's going to answer this the way you were thinking. But I think from her perspective, it's not just a standard home warranty. She's thinking of the warranty from the builder.
The good point, because if we were, then it's a different answer, right? So we'll wait for that response real quick here and see what that comes back.
She says correct.
Correct. Okay, yeah. So if it's a builder warranty, then make a list and get it all done at one time. But it doesn't hurt you. I mean, what I've found in a lot of these building situations, right? I'm selling a property now that was built 2 years ago. And so they have a 10-year warranty on structural stuff. And I think, and then I don't know what the time frame is on some of the other stuff in the property, but there's a couple of things. Like there is a hole in the firewall in the attic leading to the property next door. It's a townhome. That should have been addressed, right? That is something that needs to be done. The buyer's inspector caught it, said, "Hey, we'd like this fixed." Not a problem. Like, we're going to call the builder and have it done. That builder it was supposed to be done. I don't know. It was supposed to come out yesterday or the day before. They've now pushed it out to the future, so on and so forth. And we're in the process of escrow, so we got to get this done, and we can use that to kind of leverage our side a little bit. But understand, these builders, their goal is to work on new construction, building more homes, whatever. They probably have dedicated people to deal with the home warranty stuff or the issue stuff. But the sooner you put in the stuff, at least it's on the list, and they can work on it, and you can have them do it, when they're available versus waiting. Because if you wait, you get more people in front of you. It might take longer, and you got the potential of it not being within that window. So yes, put a list together, but I would say, start tackling the stuff as it comes up. Because is it more of an inconvenience for you because they're coming in? Sure. But at least you're getting it handled, and it's not just out there and something that may or may not get done, just based on their timeline. So that's my only thoughts on that. So, all right. Let's see. Believe Green coming back using Lexington law for 5 months. Link on who can fix credit. Lexington is a waste. So I don't agree. I don't disagree with what you just said. So
I feel bad when I hear people who tell me that's who they're working with. It's just, I'm not saying that no one has had a good result with them. Very few people are going to have a good result with them. I just put a link in the comments. So if you want it, the company I use is a company called My Credit Guy. They're not the only one out there, but it's kind of like we talk about mortgage and real estate is an 80-20 business. 80% of the people that you can deal with in that space are turds. 20% are actually going to help you and not try and get you on some subscription and hold you on a service that you don't need for a long period of time.
Yeah, and just let him know. What's his name again, Josh?
Sam.
Let Sam know that Josh sent you over there, just so can keep track of things. So, Jake is debating between 10 and 20% down payment on a property. Josh, what are the pros and cons of putting an additional 10% down?
So, Jake, if he's here, he just asked that 2 minutes ago. Tell us what the purchase price is, because it'll just put the dollar amount into scope there. For me, the PMI is very, very minimal for people with good credit. I mean, it is a small amount. You're seeing $90. So there's that piece, but there's also the piece of just having a smaller loan. So let's just say, for the sake of it, that it's a $600,000 purchase. The additional 10% is $60,000. So you say, okay, it's the difference having $60,000 in the bank. We've got the $90 difference. It's $710. So $71,000 difference of money you're going to have in the bank post closing. It's a little over $6 per thousand. Let's make it easy on Josh and just call it 6. So we're talking what, 70,000 at $6 a thousand. So 76. It's $420. You got a $500 difference in the monthly payment. That's real money, right? Well, so is $71,000. You just have to ask yourself, assuming that you qualify with either payment, which one you value more. There's not a right or a wrong answer. Most people come down on the side of, I'll take the higher payment and keep my cash liquid. Because remember, once you put that money into the house in the form of that down payment, you're going to have to pay money to get it back out, and you're going to have to qualify to get it back out, especially if we're talking over 80% loan to value. So there's my 2 cents.
There you go. Good response. FB says, can you speak on what happens if an appraisal comes in under contract? Our offer just got accepted and the appraisal is happening next week. So what happens? So understand, when you put an offer in on a property and it gets accepted, that's negotiation number one. Negotiations don't end typically there. You have the potential for an inspection to come in lower than the purchase price. You also have potential repairs that come up, which is an additional negotiation. So you got kind of the potential for multiple negotiations in a contract. Most people think it just ends, hey, my offer's accepted, great. No, it doesn't end there. But in the case that your offer comes in under the contract price, you've got a couple of different options. The first option is that you can rebut the appraisal, right? Your lender can try to look at the comps, argue the value, and see if the appraiser's willing to bring it in higher. It's easier said than done. VA loans and some other loans out there are a little bit easier to get it done on, but conventional FHA, a little bit more difficult. Josh just had success with one, so he could speak to that in just a moment. The other thing is, if it doesn't come back in at value at that point, then you have the ability to renegotiate, right? So you go back to the buyer with your agent and say, hey, listen, the appraisal came in less than expected. We'd like you to lower the price to X. They have a couple of different ways they can respond. They can say yes, they can say no, they can say we'll meet you in the middle. We want you, there's a lot of different things that can happen there. So it's that negotiation, that renegotiation that we're talking about. So, if it does come in less, the seller does not have to accept it, right? They can go back to market, but you have to understand where your leverage is, right? Why was the seller selling to begin with? What does their time frame look like? Do they have a place they need to go to? Do they have a house under contract that if you back out, theirs falls out? You got to use all of that, right, to figure out how you're going to respond. And a lot of it depends on how much it comes in less, right? If it's a huge amount, it's a bigger hurdle to cross. Whereas if it's a couple $1,000, probably not a big deal. But in my experience, when an appraisal comes in less, most sellers are willing to negotiate the majority of the time. Can't say that's going to happen here, but that's my thoughts. So Josh, what happened in your situation where the appraisal came in less?
So we've had two here recently, and one was successful and one was not. It's going to end up successful. We were going FHA. So with FHA, with any of these, we're firewalled from talking directly to the appraiser. And the FHFA recently just changed that reconsideration of value request process. So for every loan type other than VA loans, it has to be borrower initiated. So I have to get a certification from you that you disagree with the value and you would like it rebutted. We have to give them valid information. We can't just go, hey, we disagree with him. That guy's stupid. We had to say he should have used this comp, or there's adjustments here that should have been made that weren't. Maybe the size of the home was off. So in this instance, this guy dug in his heels that a permitted addition that shows his taxable square footage on the tax rolls, it was not done in a manner consistent with the rest of the house, and it doesn't have heating and air conditioning. It's in Mesa, Arizona. So from that perspective, what he's saying is, I'm not giving that value. Both agents and the buyer think the value is there. There were some other issues or flaws with it. We don't like it. So we're kind of screwed because it's an FHA loan. With FHA, the appraisal is tied to the case number, which is tied to the property. So even if the agent says, hey, pound sand, we're going to put it back on the market, they can't take FHA offers now because that for the next 6 months, that's going to be tied to that property. We've talked to another AMC that their staff appraisers went through, reviewed it. They feel also that the value is there. So we're going to switch it conventional. Fortunately, these are well-qualified borrowers. We're able to make it make sense. The payment's going to be a little bit higher, cash to close a little bit lower. So those are your options. We had a situation a month or two back, a listener here to the show down in Georgia, that we were doing a cash out FHA loan. Same thing. FHA appraiser comes back and it was insanity. We literally had a model match that was like 100 yards away from this guy's house in very similar condition. And what the appraiser did, he did a $45,000 condition adjustment because the listing that had exactly one picture said how nice the house was on the inside. And we just rebutted and asked, hey, did he go inside that house? Was he the one that did the original appraisal? Because if you look at them, ours is highly upgraded. They both look identical to me. And in that situation, we never even heard back from the appraiser. He just adjusted took away that adjustment, brought in the value, sent it back to the AMC, and we closed just fine.
Good man. Good man. All right. So we're going to move along, Josh. We got a comment here. I haven't seen this directly, but I'm going to answer it.
I looked it up here, Jeb, because I saw that one coming, and it is accurate. So Smart Fox didn't make this up. And Powell's exact comments are mortgage deserts. Some states could become mortgage deserts.
So let's read the comments. So those that are listening and not watching online at the moment know. If you guys didn't know, this actually gets published on the podcast every Friday. So if you want to re-listen to the episode in audio form, you can do that. The video is also there on Spotify as well. We do that every single week. And then every Monday is a new actual episode on the Educated Homebuyer that is not alive, right? It is a deep dive into a topic to, again, help you become educated homebuyers. But Smart Fox says, Jay Powell recently said that in 15 years, California would not have banks lending mortgages because of insurance costs. Not insurance, because insurance companies not insuring. What's your take on this? I had not heard that. I mean, obviously that would be extremely surprising if no banks were lending. I don't see that to be the case. There's too much money being made in California for mortgage companies not to have mortgage bank loans here. Because guess what? Whatever happens here, the bank still gets their money. The bank isn't. I mean, is the bank affected? Sure, but
Well, I mean, what he's saying is you're not going to be able to get insurance. They get their money because there's insurance. If there's no insurance, the bank's going to go, you can't get insurance. I can't lend to you. So the question then
we got
becomes,
California Fair
do
Plan.
we ever, and that's,
Forever.
and that's your fallback. So I have one right now in Little Rock, California, not Arkansas. I didn't know there was such a place as Little Rock, Arkansas. They send me the listing and I look at it and I see a hill right behind the house that is very dry and brushy. And I looked at it and I go, I think we're going to have an issue. So we had 4 insurers turn it down. California Fair Plan steps into the void and is going to do it. This is a $650,000 house that is going to have a $7,800 a year insurance bill.
Yeah, I mean, again, not ideal. At some point, the federal government has to again, they come in and never make situations better. So I'm not expecting them to come in and just solve all the problems. But at some point, the government has to get involved when companies aren't willing to do certain things, right? There has to be some sort of blanket deal. And I don't know what that looks like. And I don't know, it's not going to happen tomorrow. But my guess is at some point in the future, there's some sort of federal backed insurance. I don't know that I might be making this up and you guys can think I'm a lunatic, but I do think there has to be something there. Car insurance, house insurance, all of this, there's going to be something that is federal that relieves some of the pain.
And again, the government is the insurer of last resort, the bank of last resort. The federal government, the state government in California can't afford to have that happen. So whether just spending now, if everyone has a $7,000 to $8,000 a year insurance policy in California, is that going to affect home prices? It absolutely is. It will reduce demand. So to what degree, you don't know, but the markets adjust over time. Jeb, we're 55 minutes in. I know you got a hard stop here, and we have some good questions here. Right. So I wanted to make sure we get to them. So Degenerate Learner, are you seeing multiple offers on houses yet? Over asking. And if not, when do you think that will happen? I'm looking to start hunting in April and hoping to avoid bidding wars.
You know, the one listing I have at the moment is in escrow. It was not a multiple offer situation. We put an offer in on a property in South LA, Compton, actually, for a buyer a couple weeks ago. It got accepted. Supposedly they had additional offers coming in, but our counter offer was only to us. It was not a multiple counter offer. So can't say for sure whether they had it multiple or not, but I think right now most houses probably don't have multiple offers just because of the environment as a whole. If something is priced correctly, if you got that HGTV ready house, it's priced correctly, it's in the great neighborhood with the great school, probably multiple offers in those cases. But I think as a whole, most areas aren't experiencing that. But the Northeast, some of these areas with very low inventory and still some, quite a bit of buyer demand could be seeing that. So I think it's going to come down to where you're located, right? If you're in Florida, Texas, some of these areas, probably no chance of a multiple offer situation in many cases because there's just so much to choose from. But things will start to change as we move into the spring. A lot of it has to do with rates and affordability. So I'd say check back, before you dive in, and we can touch on it again.
And Jeb, what I would say that we're seeing is not so much multiple offers, but also not sellers just going, yeah, awesome, we got an offer, we'll take whatever. There's some give and take, some back and forth, timing, prices, concessions. Had one in Houston this last weekend from a listener, and they had a little back and forth. He was hoping to get it a seller concession and a lower price, ended up paying $2,000 over list, but got a very nice seller concession to get him into the property. So seeing negotiations, but not so much multiple offers. They're there when you see really nice properties, especially that are well priced. Jeb Anthony Gonzalez is based in Southern California, saving about $3,500 a month with family, have about $130,000 saved. Should I buy it before spring season or save more for a fixer-upper?
Um, I don't. I mean, again, you got to find. Like, can you find the property out there that you want, right, at a price that you're comfortable with? And are you comfortable with the monthly payment and all of that? So you're saving about $3,500 a month. I don't know. I mean, the longer you can stay with family for free and save money, the better off you're going to be long term. I don't think there's a rush at the moment to go out and buy a house, even in Orange County, or you did say Orange County, Josh?
Southern California.
Southern California. So the longer you can hold off, the more money you're putting aside. I think with rates staying where they are right now, you've got some time on your side. If you start to see rates drop, then that could impact prices a little bit more, and you might end up, end up paying a little bit more. But at the same time, it's all about finding the right property for you, your family, whatever you're trying to accomplish. If it's not out there, then don't rush it. But if you're seeing a bunch of homes that kind of meet what you're looking for, then just plan accordingly, right? And just see what happens. But I don't think there's a rush.
I agree with what you're saying. There's no rush, but I would be in the market. I'm picky, so if I'm comfortable waiting. But if something perfect comes up next month and I could do it, great. And if nothing perfect comes up, I just keep waiting and saving money. So we have a comment here. FB says, we just sold in San Diego, had multiple offers. The house we offered on also multiple offers. So again, it just depends on where you are, if the home is priced right, all that fun stuff. We
Absolutely.
have, Jeb, here's one for you.
Yeah.
Osama says, I just got good rates on a home I like. My realtor said he will do a contract/offer, spend more than 35 hours. Should I get a new agent? If your offer doesn't write an offer on a home you're interested in for a day and a half, should you get a new agent?
I can't really comment on that because it's like me bad mouthing another real estate agent.
You want me to
But
do
listen
it?
to Josh. Listen to
Yeah,
Josh.
like that's most realtors. I mean, we show the numbers here every week. Mortgage people, real estate people, the volume is down from where it was 2 years ago. It either tells you that they're too busy, which is good for them, or they're just not all that interested in putting it together and helping you.
Yeah,
So
are they full time, right? Or they have another
yeah,
job and not focused on what you're. No, you want the right. If there's a property on the market and you wanting to write an offer, a reasonable offer, then they should be all over it. If it's not a reasonable offer, then they should tell you, hey, listen, I think this is crazy. I'm not even going to write this. You need to find another agent. That's how it should be handled. But anyhow,
we got
hopefully that's helpful.
one last good one. You
Yep.
got time to answer it?
Yeah.
Okay, cool. Smart Fox, if I buy a condo and the structure burns down, who has the responsibility to rebuild? Is that 100% the HOA?
It depends, right? So HOAs can be, or properties that are located in homeowners associations, some are different, right? Condos, townhomes, whatever, single family homes. Some single family homes, the HOA is not responsible at all. In this case, I'm thinking that you have a condo or a townhome, or you're thinking condo or townhome. Oh, you said condo. Never mind. If it's a condo, there's two types of insurance. One insurance covers the entire structure, right? The HOA's master policy covers the entire structure, the outside of the property, as well as the interior of the property. It'll rebuild it with the walls in, the countertops, the cabinets, all of that stuff. That's one. The second option is the master policy only covers the structure of the building all the way to where you get to drywall inside the property. They don't do the drywall. They don't do the countertops, the cabinets, the flooring, all of that stuff. That requires an additional policy, which is HO6, right, Josh? Insurance policy, where if fires burnt down, HOA would rebuild the outside. Your insurance would come in and cover the inside. So depends on the type of insurance. I see them both ways. You got to figure out what that actual association covers in that situation. Did I miss anything there?
No, I think it's good.
Okay.
Jeb, Anthony Gonzalez came back and just
Yep.
broke my heart. He says he's already underwritten and waiting for an opportunity if it comes. Thank you guys. We're here in Southern California. So for all of you, I feel like
Unbelievable.
some of you guys don't realize Jeb sells houses, granted a smaller radius. We do loans most anywhere throughout the country. We do talk to probably one or two of you a day, but then we get ones like Anthony that we don't get the opportunity to talk to. So reach out, call.
I'm going to be very blatant
use
here.
the
If
form.
you're buying a house, call to get a quote. Really simple. If you're starting the process, you could start with us or you can go somewhere else. But either way, call and get a quote. Use the people that you're getting the information from to get to the next step, right? I mean, it's the logical thing. If you trust us enough to listen to the information, then you should trust us enough to help guide you through that process. So with that said, we appreciate you being here. Sorry, I've got a hard stop. I've got to go get kids. But we'll see you next Wednesday. Until then, adios.
Amigos.